Hey traders, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, April 15, 2024. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? A lot of stuff on the docket, obviously. First, we're going to do a review from a big picture perspective, where we are, what the next big time price levels are. Then we're going to drill down to some other charts. We're going to look at a trend analysis. We're going to look at some stocks. We're going to gauge where the intermediate and longer term picture is on some of the more important stocks around the marketplace. Let's start with the bigger picture. We're in an on-time month situation. The month of April is an on-time month situation. So far, so good. Weekly chart, and we'll get to that blue horizontal line in a moment. Most of you already know what that is. Weekly chart is coming back to run a test in the vicinity of home base. Why is that? Because markets don't like to get charts. Price levels don't like to get too far from home base. They can get far, they stay away for a little while, but ultimately they come back to pay a visit and run a test at home base. Home base is the 20-period moving average. We've been talking about that for years and years and years. It's served us well. So therefore, we know from a weekly chart perspective, the market is in an uptrend. Weekly charts in an uptrend. Money managers are not concerned with what's going on right now. We discussed this in the live room today. Money managers, mutual funds, pension funds, long-only hedge funds. You know, the folks that say you have to be a long-term investor, and that's in response to saying, but the market's going down. Their only response is, well, you have to invest for the long term because nobody can time the market. Really? Maybe you can't time the market. We can't time it each and every day, but we certainly have a better handle than you blokes. Net, weekly chart uptrend coming back to pay a visit at home base. Should you find support if they got to home base? We don't know that they will get to the 20-period moving average on this move. They can, but if they do, should we expect support in around 495, 494 in the spiders, something like that? And the answer is yes, you should. Write that down, put it on a sticky note. Now, let's get down to the daily chart. And what exactly is this blue horizontal trend line? That we've been talking about for a few weeks, not a couple of days, but a few weeks. We always said, you can go back to the videotape from whenever. We've always said the first really important place that the market's going to come back to run a test of is the most recent big time breakout area. Where is that? 503.50. Check the videotape. One more thing from a big picture perspective. We had the solar eclipse on the 8th. When was the 8th? Right here. What happened since the 8th? Other than a couple of bounces along the way, the market's been nothing but down since the 8th. I'm not saying I have a patent on the eclipse conversation. What I'm saying is, and do the homework yourself, you'll find market turns a lot of the time, not every time, a lot of the time at those tinfoil hat events. We talked about it at least a dozen times, before and after. Now, let's drill down to, for example, this week, tomorrow. For example, this week is regular way options expiration week. We should expect, should in italics, we should expect both ways. We should expect the market to trade in both directions. We'll use 503.50 as a near-term bogey, a near current price bogey. Below that, and the door opens all the way down to the gap down here at 497, another 30, 40, 50 handles or so. From a numbers perspective, running calculator type stuff, formula type stuff, the next number below 503.50 happens to be 494.60. Now, it's not the gap, it's slightly below the gap, but just as happenstance, and it's not the reason why, but just by happenstance, that number comes in right around that 20-period moving average on the weekly chart, Funny how that works. So I would put that number down on a sticky notepad, 494.60, 495, 494.50, 42, somewhere in that neck of the woods, and you see a safety net underneath, the 100 period moving average coming in right around 490, give or take. And it's rising, so over time, over the next several days, that will rise upward into that area around 494, 495. What about turnaround Tuesday? Market finished pretty much on the lows today, near the lows. Will you get a turnaround Tuesday, snapback / dead cat bounce situation? It's possible. If you're getting that bounce in the pre-market, you can expect some overhead resistance right around 509, give or take. But as you know, Inside the Number members and Live Room members will have the bona fide numbers first thing in the morning, regardless of which way they're going in the pre-market. We'll have both sides. We do the pre-game warm-up routine. Anybody make money today in the Live Room, Inside the Numbers, early on? Anybody short the highs today? If you did, put it in the comment section under the video, please. We'll take a look at the commentary. Remember, pause the video, read the notes, go back to the chart, and double-check the work. This is based on some pre-market activity. We'll notice above this stuff, doesn't matter what it is now, opens the door for another leg higher toward a spike above 515 for starters. Okay, that gives us something to work with. Let's see what we have around 835. We've got a sell the rip situation on our hands. Okay, that's interesting. Might have been a benefit to be in the Live Room, Inside the Numbers this morning. We've got overhead resistance at the trend line around 513.80, give or take, up to 515.15 with a way station somewhere in between 514.35. Anywhere in there is a likely pullback in the other direction for a scalp with potential. Well, it turned out to be a whole lot more than a scalp, but that's the way these start. They morph from small things to larger things. It's only wrong or incorrect above 515.82. So what did you have an hour before the market even opened today? You had an area you were willing to take a short trade. You knew where it was wrong, and most people haven't even got to work yet or had a cup of coffee. The thieves in the morning have been to the zone and found resistance above 515.82 on candle closes. That's the bull case. The trend line up to 515.15 still saying is overhead resistance. Now what about the 918 post? Check this out, because they were up there. The most difficult trades to take are generally the best places to take the trade. Author, not sure, but it's true. And what was I saying in English? The resistance zone is a tough place to take a trade, the best place to take the trade. Pause the video, read the notes, go back to the chart, and double check the work. It's all in here. There was a long trade. There was another attempt at a long trade that didn't work out. And then traders from the Live Room, traders from Inside the Numbers, traders from the videos like this one, everybody should have known about 503.50. And by the way, just so you can get the visual, you can see the trend line, 515.15, overhead resistance, and the rest is history. Sometimes they come up short, other times they spike them through. Low of day happened to be 503.58, coming up 8 cents short. We know they do that. They come up short, they spike them through. What we talk about every single day in the Live Room and other places is we don't split hairs over pennies. This is the number. This is the general area. Sometimes they do the one thing, other times they do the other. The number is what's important. What's going on over in Camp IWM? And this is interesting because we talked about this in the Live Room in real time this morning. Early on when the S&P was bouncing higher, the IWM was non-participatory. It was not participating. It was up a little bit, but nowhere near the same amount at the time the spiders were. So we use that as somewhat of a guideline, somewhat of as an informational piece, at least in real time, saying, look, this can't be a positive, the fact that we have a negative divergence of the IWM. Doesn't mean the market, meaning the S&P is going to collapse, but it can't be a positive. We watch it. Where are the transports? What else is going on out there? It's how we uncover and peel back the onion to get the picture, the puzzle pieces put together to give us the picture of what's going on. All these little components throughout the day, intraday charts, daily charts, all kinds of markets. We get our clues from around the horn. Each chart is independent from one another, but there are certain indices like the transports, like the IWM, that are good leading indicators. They give clues. The semiconductors gives a clue for the tech space. Look where the IWM is compared to the SPY. They're below the 100 period moving average. Where are they on the weekly chart? They're below the 20-week moving average. You have relative weakness. However, where are they headed? What's the next big place? It's jumping out like a sore thumb. It's the 200 period moving average. We're going to call it 192.50. Whether they spike it through, whether they come up short, in and around there should be bona fide chart support at minimum from a short-term basis, like we always say, just like the SPY 503.50. At minimum, you're going to get a bounce back in the other direction. From an intraday perspective, at least. Sometimes you wake up tomorrow, for example, on Turnaround Tuesday, you look back and say, look at that low. Now we're up 75 points. That stuff happens. So no guarantee the IWM gets down to 192.50, but if they do, in and around there should be chart support. IWM, favorite market leading indicator. Second favorite market leading indicator, the folks down at the transportation department. They're coming into an area of support. Why is that? Below these lows, 1 low, 2 low, 3 low, spike the low, get to a breakup candle low, and do what? Rip it back up in the other direction, run a test here, at least from an intraday perspective. You should get a bull-bear battle in and around 15,265. You can watch it, see what happens for yourself. Into the 50-week moving average. You know what's in jeopardy? How about this bullish box? The bullish box is in jeopardy. Weekly chart, we've got a breakup candle low. They give up this breakup candle low right here. The low is 15,198.95. Give that up, and that opens the door for a whole nother leg lower. It doesn't mean you get immediately the whole other leg lower, but that's a big time spot. It's already been tested. Back down there again. Testing again, if they do, going to be a very critical test. What about the folks down at the Q department? The Q people. There's a gap down below current price, down here around 426, give or take. And look what you have here. You have a weekly chart, 20 period moving average, same place. When you see chart after chart start to line up where the bigger time frames are coming into a very important place, you may not get a reaction to the minute. You may not get a reaction to the day. But when you see these things occur, you have to pay attention while they can spike them intra-week. What's going to happen by the end of the week? Will it be support? Did they just come back to run a test of home base, and is that it? And that's just a little correction. Forget the news. Forget the war. Forget Israel, Iran. Forget whatever else is going on election-wise, politics, geopolitics, Ukraine, Russia, China, Taiwan, North Korea. It doesn't make any difference to what's going on in the market. It appears that it does. It's an excuse to move the market. They give the market a jolt on the news events. But in the end of the day, the market is the market. It trades how it trades. The news events are plugged in after the fact in a large majority of the cases. They're the excuse for the move. They help price get to a certain place, but we know the places in advance. What about the 503.50 in the SPY? What did the 503.50 2 weeks ago in the SPY have to do with Israel and Iran? Nothing at all. What was it today? The excuse to get there. How you doing? XLF, daily chart rollover below the 50-day moving average. Trend is down. Obviously, where are they coming into? How about the most recent breakout area? How do you identify that? Right here. And they're almost there. Now, what does that coincide with, by the by? Well, on the daily chart, the last breakout area, 39.45, and you can see here, I know I changed the color on you. That's slightly below a gap. It's a bona fide breakout area. We've seen hundreds, dozens, thousands of those. It's right above the 20-period moving average on the weekly chart. XLF getting too far from the 20-period or home base. We talked about that while it was up here. What are they doing? Coming back to pay a visit, check in at, run a test of home base. Home base kind of coincides with the daily chart, last breakout area. Maybe they spike that, touch the 20-period moving average on the weekly chart. That's going to be traditionally bona fide support, at least from a short-term perspective. Even if they spike it through intra-week, they'll also rally back to run a test of it as well. See how we look at chart after chart after chart, and you start to see the same theme. Now, somebody might say, well, that's too easy. Well, maybe it is, but what I'm seeing is the same theme, and I take it at face value. The 20-period moving average hasn't been visited since October of 23, okay? Are they just going to cut through it like a hot knife through butter, like it's not even there? Or are there going to be an semblance of buyers to come in and support the market at a logical place from a weekly chart perspective? You choose. SMH finally breaking the chain here of this sideways routine, coming into the 50-period moving average on the daily chart. But that's not the same as it was before. Why is that? Because we've already been to this number, right below the 50-period moving average. That was our test and bounce. Second time around is not the same. What do we say in the live room every single day? First time, best time. Where is its 20-period moving average? A whole lot lower, down around 200. Does that mean they get there? No, it doesn't. Just noticing where they are. They're still extended from home base from a weekly chart perspective, more so than the majority of other markets or charts that we look at. So what's the interpretation? Well, there's two sides. Let's look at both. Remember, we're the umpire calling balls and strikes. Side number A, they collapse, come all the way down to the 20-period moving average, and all the other markets are a whole lot lower in the process if the SMH is coming down to around 200 from today, 217. That's a big move. What's the alternative? Well, they're above all the moving averages, so we know the trend is your friend. It's a bullish trend. However, sometimes they need to do what? They need to eat time off the clock, which is also a corrective move. Eating time off the clock gives home base a chance to creep up to price, while price slowly creeps down to home base, all the while making a bullish, consolidation-ish, flaggish kind of situational pattern. So right now, from a weekly chart perspective, if you didn't look at the news, you didn't see the daily chart, you didn't see the other markets, what would you say here? You'd say, well, this is bullish. This is in an uptrend. It's just a little sideways / pullback situation well above all the moving averages. So it makes sense that they'd pull back a little bit to work off some of the non-measurable overbought condition. Wouldn't we? Yeah, pretty much. So let's say they never get down to the 20-period moving average. Let's say they stay above 213.35, give or take. Guess what? That's bullish. They're setting up for another move higher. Use 213.35 as a bogey. Get below, and you could even make that a little bit lower. The gap over here is 211.95. You can use the gap as your benchmark or gauge. Say, look, they start closing daily below the gap, and it really does open the door for lower, and then we have to start looking down here toward the 20-period moving average. But if they stay above here, then this is bullish, just eating time off the clock, and this is just a corrective pullback situation. Be the umpire, calling balls and strikes. Let's look at some of the world-renowned stocks. The Fab 7, now it's a Fab 6 apparently. Tesla being thrown out for most people's seventh pick, if you will. Amazon, anything wrong with this weekly chart? No, it's in an uptrend. Again, same routine with the 20-period moving average we just discussed. Maybe they go sideways, maybe they pull back, but there's nothing technically wrong with this trend whatsoever. We're going to stick with the weekly charts for the big picture look at some of these stocks. So Apple, let's get rid of these lines so we could see it better. Apple's different than Amazon, totally different chart. Below the 50 and 20-period moving average, 20's rolling over, they're converging, and it's making a bearish consolidation-ish type of situation above the 100-period moving average. So this is bearish until or unless they get back above the convergence of these moving averages. For argument's sake, call it 183. Microsoft, what's going on over here? Anything wrong with this chart? No. Obviously, the daily chart's down a little bit. They're selling off. That's fine. But what about the weekly chart? 20-period moving average there it is again. What happens if they come below the 20-period moving average? Next bona fide place, 384.30, last breakout area in the sequence. Somewhere in between, halfway home, there's something called a midpoint phenomenon that traders in the live room, traders that have taken the course, lazy e-mini trader, lazy gap trader, they know about the midpoint phenomenon. It extends a little bit more than what's taught in the course, which we discuss in the live room each and every day. But technically, from a weekly chart, longer term perspective, there's nothing wrong here. This is a corrective move in a pullback situation. You look at the daily chart, look at that reversal candle. That's fair enough. What happens when they get down here? They'll be into the 20-period moving average on the weekly chart that most people don't even know exists. What's going on in Google? How about 160? That was in the room last week. What's the target in Google? 160. That worked. Well above all the moving averages. A pullback is normal, garden variety, healthy market type stuff. This doesn't mean a collapse. It doesn't mean a crash. It's a pullback well above all the moving averages. Nothing more, nothing less. 150 to 151 will also be some short-term intraday support for Google. Write that down. Put it on a sticky note. How about NVIDIA? Monster stock. Anything wrong with this stock? No, well above the moving averages. They're eating time off the clock, pulling back. And on this chart, after this type of move, this is a reasonable, normal, garden variety type pullback. It's going on for the fourth week now. Maybe it lasts 5 or 6, but that's normal garden variety stuff. Above all the moving averages, the trend is your friend. There's nothing wrong with NVIDIA. I'm not saying they get to the 20-period moving average. 780, 790, 785. In there will be some support. Write that down. Meta, anything wrong with this one? You see the theme here. You see the trend. Most of the big-time stocks, the widest held stocks, the ones everybody owns in mutual funds, 401ks, hedge funds, pension funds, whatever funds, index funds. Those stocks, there's nothing technically wrong with them. There can be. It can morph into something much more serious, but right now, they were so far extended from home base on the long-term charts that this is normal garden variety stuff. So what are we saying big picture? Market's going through a correction. We were looking for a correction. We were looking for a turn. They're in the midst of the correction. When the correction is over, the market will likely go back up. When's the correction going to be over? Well, it could be over in a week, could be over tomorrow, could be over in 2 weeks. We'll know when the correction's over when we know. But we're looking for the correction to be over rather than lasting into a morphing crash / bear market, all that stuff. Not yet. We're not there yet. How about Tesla? Weekly chart, well, turned into a shit show. Bearish pattern leaking lower, you had to move lower, bearish wedge. Move lower, bearish flag. Starting to move lower, guess what? Breakup candle low, 136, 137. That's really, not to say they have to get there, but that's your next big time target. I would put it on a sticky note if I were you. Have I told you how much I appreciate each and every one of you? Without you, these videos are not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, My Strategic Forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.